What's good, YouTube? It's your boy G Lex back in another video. My bad, y'all. And in this video, y'all, I'm gonna be explaining to y'all. I'm gonna be showing y'all basically like a concept that I knew about. Like I've known this concept like for a long time, but I never had to put it into words. I was never able to put it into words until I read a book. And this concept is called the income sheet and the balance statement, bro. And basically, what it's all called is it's called the flow of income, bro. So I'm gonna be showing y'all what the flow of income is, bro, and how this can benefit your life, bro. Y'all ever heard someone talk about leverage? You need leverage in life, bro. That's what this is. It's leverage, but it's illustrated so y'all can understand it, bro. Without further ado, let's get straight into it, man. Make sure to like, comment, subscribe to the video, y'all. Let's get right into it, man. I'm gonna do some more bangers for y'all. Alrighty. So I'm gonna put it up on the screen so that y'all can see it. Let's go to a new page because that's the old one. So let's go to a new one, right? So now let's write it down, right? Hold on, this is a different thing. Income sheet. Okay. And actually, no, let's write income sheet, but like I need it to be the flow of income. The flow of income. All right, the flow of income, y'all. What the flow of income basically is, what that is basically how efficiently you can make your expenses less than your profit. Basically, how easily your profit can outpace your expenses, basically. So we got an income sheet and then a balance statement. Okay. So your income sheet, right? Your income sheet will have two main categories. It'll have your income and your expenses. Pretty simple. Income and expenses. Your income sheet just shows, hey, you got this much money coming in and this much money going out. So let's say you got, I'm gonna use green for this example, right? Let's say, actually, let me fix this brush up a little bit. Let's say you got like $10,000 coming in, right? And your expenses are $5,000, right? So your income sheet now is up. It's up $5,000. That's a positive income sheet, and that's good. That's where you want to be at. Income sheet is going up. You have more income than your expenses. That's good. That's how you build wealth. Is having more income than your expenses. Now the balance statement, it's like the income sheet, but it's a lot more in depth and dynamic. You feel me? So now let's say you have this box. That box is income. Let's do income again, right? That box is income. And then you have another box, which is expenses. But now, instead of just income and expenses, now you also have a box called assets. Now you have this box that's called assets, right? And then you have another box called liabilities. Now, income can be, because income in the income sheet, that's everything you got. That's your job, real estate, everything. You feel me? But income in the balance statement, that's actual legal income. That's basically just what you're bringing in when you spend time for money. So basically just a job. like what your job is. You feel me? So let's write that down. Income, income, job. Actually, no. Let's do that in black. Income is job. So now expenses is bills, payments, etc. Right, etc. And liabilities are things that you own that make you no money, or things that you own that's taking money out of your pocket. So a liability would be like your house, your own house, right? House, car, hold on, car, and etc. Right? So now, let's say, for example, you have, let's say now, because assets are also stocks, rental properties, and then other things, etc. Right? Okay. Now we've established that income is your job, and then liabilities are a house or a car. Bills are payments and stuff like that. That's expenses. And assets are stocks and rental properties, stuff like that, right? So now, let's say that you're making 5K. Let's actually duplicate this real quick because there's going to be multiple types of balance statements, right? The balance statement is what you really want to focus on as like you go more into like owning businesses and stuff like that. The balance statement is what you really want to focus on. So now we have this balance statement. So let's call this the poor person's balance statement. Poor person balance statement, right? So now the poor person's balance statement, right? They get let's say they have a job and they're bringing in about $4,000 per month. Let's just say 4,000 per month, because that's a pretty good number. You feel me? That's a pretty good number. 4K per month, and that's in income. Let's actually replace that because I mean we know where income is now, so let's replace that. Income is $4,000 per month, right? And that's good because now you're bringing in money. That's positive money. That's positive. You feel me? So that goes up. So they have $4,000 per month in income. What they do with this, first of all, we're not gonna count tax, but normally tax will be your expenses because you don't see that money after like taxes, right? But for the sake of this video, let's just assume they don't. Let's just assume 4,000 is what they take home. Let's just assume that, right? So they got 4,000 per month in income from their job, right? And they use that to pay. They use that to put that straight into bills or straight into expenses, right? So, or actually, no, scratch that, because before the expenses come in, you gotta buy the expense. You feel me? So they put that into a liability. Let's say they put that into a new credit card or a new house or a new car. Let's say, for example, for the thing they use it for a credit card and a car and a house. So let's say they buy a car and a house for $10,000 per month. So no. So the house, the mortgage is let's say $2,000 per month. Okay, and then the car note. Car note is, let's say they got a really nice car. Let's say they're paying $1,000 per month. That's money that's taken out of their account. That's all money that's going down. So now that money goes into expenses because that's their liabilities, and their liabilities it goes into your expenses. The liabilities and expenses are the same thing, however, they're just said differently. So your expenses and liabilities, your expenses are now $3,000 per month. $3,000 per month, right? Let's say that. That's how much money that they're losing every month is $3,000. So now they're left with about $1,000 profit. So now they're left with a net of $1,000 of profit. Now, what a poor person would do, they would just put that money right back into their car note. They wouldn't even touch the assets over here. You feel me? Poor people don't even touch the assets because poor people, first of all, whether they're not financially literate, they don't know about these opportunities, they don't touch the assets. You feel what I'm saying? So that money goes right back into their expenses. And they end up with more money. That turns into $4,000 every month. And then now they're left with no money at the end of the month. Or actually scratch that because they don't even do that for expenses. They do that for like their lifestyle. So that goes into more of their lifestyle. Lifestyle inflation, right? So that adds way more money. They end up using all that money they have at the end of the month. That's what a poor person does, right? So now let's look what the middle class do. Let's look at the middle class's about balance statement, right? So middle class, let's use the same type of income actually. $4K per month, 4,000, same thing. Money going up, yep, profit. And now they do two things, right? They just buy a house for $2,000, but now they're also diversifying and they're putting their stocks into they're putting the money into stocks or safe investments. So now instead of just buying a car and a house, they bought a car in an apartment or something like that for like, let's say $3,000 per month, same thing. Goes into there. Actually, let's change that to red. Sorry. Change that to red. So now they pay a car note and a mortgage of $3,000. They give $3,000 per month. And they also invest their money into stocks. Oops. Shit, hold on. Let's just use this. Okay. So now they're investing their money into stocks. So let's say they put $1,000 into stocks and they get like 10% annually. So about $100 per year. Let's say that. So let's say minus 10, minus 1,000. That's $1,000 per month. And then they're making it $10 per year. $10 per year, right? So at the end of the day, they're making only about like $10,000 per year. Because again, that money, that $3,000 per month, feel me? This is overly simplified, but this is overly simplified, but I just want y'all to get y'all an understanding about this shit, right? This is overly simplified. Negative $3,000 per month. So now this is like middle class and like this is like lower middle class. Because they got good stuff, but like they're still not really good, you know what I'm saying? So now let's move on to what the rich people do. This is where the fun part happens, right? So rich people, most of them got like, I'm gonna even say like, shit, let's say like Same thing. 4K per month. 4K per month. And now they don't go for liabilities. They don't buy liabilities. They go for assets. Rich people don't buy liabilities first. They don't pay their bills first. Now, this is something that I'm learning myself, but this is something that y'all need to understand. Rich people don't pay bills first. Rich people pay themselves first. Rich people pay everybody else last. So let's say now, instead of actually buying a house for themselves, they buy a house to rent it out. So now it's still the same. They pay a mortgage of $3,000 per month. Actually, no, let's say like $2,000 per month. So the mortgage, $2,000, and the car note is $1,000. Oops, let's rearrange that. Car is $1,000, right? But, however, the thing is that they don't live in that house. They also have an apartment. So now they're also living in an apartment for $1,000. So now they've used up all their income. They've used up all their income. Let's say apartment and like groceries and shit. It's like, I'm not gonna lie, like that's kind of unrealistic. Again, this is very simplified and a little bit unrealistic, but it's just showing y'all like an example of what rich people do. Apartment and groceries. So now their expenses don't change. Their expenses are still $4,000 per month, right? That's their expenses. However, they used that house and went and rented it out. So now they have a tenant in there that's paying them $6,000 per month. Because it's a really nice house. They're paying $2,000 on it, they're getting $6,000 per month, right? For the tenant. Their total profit is $2,000 per month. And now they're going to put that money right back into it, or right back into more money. And they're going to put that money right back into getting more assets, which makes them more money. So it's a cycle. That asset goes into your profit or your income, which that income goes into your assets, which generate more money. You feel me? Your bills still stay the same. So your bills will go into to expenses, right? But your assets goes into your profit. Or, your assets goes into your income, which makes you more money. You feel me? Now let's look at the old one I made. The flow of income, right? Because this is what we just talked about, right? So you have income from your job, and then you have assets. You have assets. Actually, let's use this. So you have income from your job, you got assets, right? You got assets. The income is this is if you have no job. Income has your assets giving you money, right? And then your income goes into your expenses, which that's only a little bit. Because you're getting all this money from your income, and you're not really getting that much money, right? This is the example of like someone with a lot of bills and like also a lot of income because they have no job. Now let's see what you do when you have a job. You see this. So you have a job. This is the ideal cash flow. You have a job or profession, which makes you this much money, like let's say like $1,000 per month, and you put this into your assets. Your assets, you feel me? You can put it into your luxuries and liabilities because your assets are going to pay for your luxuries and liabilities. You feel what I'm saying? So that's what this thing is right here. That's what I missed actually. That your assets also help pay for your luxuries and your liabilities. So this also right here goes right here and pays for it a little bit. But again, that's a choice because they choose to put the money right back into it. You feel me? So now once the car is paid off, all that money is going right back into your business. You feel what I'm saying? So rich people use their assets to boost their income, which that income puts more money back into their assets, and it also covers all their expenses and their liabilities and their luxuries. You feel what I'm saying? So long story short, at the sum of it, the flow of income states this. You have a job or a profession, because you can't go nowhere without a 9 to 5, I'm not going to lie. So you have a 9 to 5, and you use the money from your 9 to 5 to go into your assets and make assets, right? And then these assets generate income that you use to put back into your assets to make more income and to pay off your luxuries and liabilities. That's the ideal flow of income. Now, that's pretty much all I got for y'all today. If you want to see more content like this, be sure to like, comment, subscribe to the video, y'all. Smash that like button, notifications, all that stuff. Appreciate y'all watching the video, y'all. And man, we out.